on to the afternoon's BVC pre-conference seminars. Starting with our first seminar here from Jones & Roth CPAs and Business Advisors is Jordan Dawley, CPA and manager. His expertise includes business and individual income tax, ERISA audits, accounting system implementation, payroll filings, pension plan administration, and tax research. Jordan specializes in providing tax planning and preparation for individuals and businesses, working closely with our dental practice niche. He enjoys connecting with others in the local business community and providing solutions that have an impact on local companies and their owners. He currently serves as the audit chair of the local chapter of Risk Management Association. Jordan is a native of Bend, Oregon. He graduated as a dual major from the University of Oregon in 2011 with a Bachelor of Science degrees in accounting and economics. Very impressive. Jordan will share his advice on setting it up right with a tax-smart approach to startup business formation. Welcome back to the seminar stage, Jordan. Where are you, my friend? There you are. Take it away.
Thanks, Shannon. Thanks, everybody, for being here today. Excited, obviously, to be here again and to have another conference. So thanks for being here. So as we alluded to today, we're going to talk about tax-smart approach to business formation. But before we get into that, a little bit about Jones & Roth. You probably know some. Most of you know some about us. We are the largest CPA firm headquartered here in the state of Oregon. Thank you, sir. Beautiful. We got offices up in the Portland area, Eugene, and Bend here in Bend as well. So a couple things I'm going to talk about today. I'm going to go through legal entity decision and how that impacts you from a tax consideration standpoint. We'll talk about initial accounting method selections, how that works, how to pivot from one to the other, and the implications there. Then we'll move on to the costs of starting a business, startup expenses, and how those are treated. And then we'll talk about intellectual property as well, and then I'll open it up to a little Q&A as well at the end here. The most important slide of the day is the disclaimer, right? Anything I say here is not binding, right? It's my own opinion, does not represent Jones & Roth. Talk with your CPA. If you don't have one, I happen to know a pretty good one, so keep that in mind. All right, let's talk about legal entities. We're going to focus on 5 major legal entities today. We've got sole proprietorships, general partners, C corporations, S corporations, and limited liability companies. All right, so sole proprietors, right? It's right in the name, sole. It's one person. There's no legal formation required, and we report the activity, the net income, your income less expenses directly on the individual's tax return via what's called a Schedule C. Importantly, there's no inherent limited liability in this structure initially. And then the owner's not an employee, so they wouldn't pay themselves wages, and any income they recognize for the year is subject to both income tax and self-employment tax. Okay, contrasting that is our general partnership, and as you guessed, right, partnership, we were talking at least 2 people by rule to form this type of entity. No legal formation is necessary, but we strongly recommend you get a partnership agreement in place. You could probably imagine how awkward it gets when you're deciding who owes what, what earnings go to who, right? So the structure there is vastly important. This is famously called a pass-through entity, right? So the business itself is not paying income tax. Instead, it passes through to the owners via a Schedule K-1, and they get the pleasure of reporting that income on their individual tax return. Again, similar to sole proprietorship, there's no inherent limited liability, right? So your personal assets are exposed to liability, and creditors related actions to that of any partner. Like a sole proprietor, the income that flows through via the K-1 is subject to income tax and self-employment tax as well. Now let's talk a little bit about C corporations. C corporations are effectively any corporation that doesn't make a subchapter S tax election. We'll get into that here shortly. Importantly, there's no restriction on the ownership or the various classes of stocks you can implement there. Different than a sole prop or general partnership, the entity itself does pay income tax, right? So you prepare a Form 1120 that reports the corporate activity, and it's subject to corporate level taxes. Importantly, if there's a loss, it carries over from year to year and can be used to offset future profits. Very beneficial in a C Corp. The owners of a C Corp, right, don't have any tax implications until they start receiving dividends or until they sell their stock, right? So it's advantageous from that standpoint. However, when you start paying dividends, dividends are non-deductible by the business, so you get into this trap of what's called double taxation, right? The C Corp profits are taxed, the dividends paid out to the owners are also taxed. Every state does it slightly different. Here in Oregon, we have effectively a gross receipts minimum tax based on your Oregon-sourced revenue, so just be aware of that wrinkle. Additionally, on C Corps, owners who are performing services for the corporation must take a reasonable but not excessive salary, right? Really specific, though not exactly spelled out in law. And then the limited liability is inherent as long as corporate formalities are observed, right? So there's no personal exposure to the shareholders. Obviously, a huge benefit there. And then generally, this is probably not the most tax-efficient approach for a family-owned, profitable business. So there are better vehicles for them. And then this is, in fact, the preferred vehicle for startups. It's because of the flexibility of the classes and exit considerations that we'll get to in a little bit. But that's usually the vehicle you'll see for venture and angel investors. Now, S corporations, right, or the flip side, right, or any corporation that has made a subchapter S tax election, it's merely a tax election. We make that on a form 2553. You get a pretty little letter from the IRS saying you are an S corp as of this date. Some people frame it, some people don't. You know, you do what you want with it. But an important difference here is there is restrictions on class of stock, right? You can only have no more than 100 owners at any given time, and there's not multiple classes of stock, right? Not preferred, class A, class B, it's all one class. And another caveat, right, is owners need to be non-foreign in general, and other business entities cannot own the stock, right? So great restrictions there on who can own S Corp stock. And this is similar to a partnership in that it's a pass-through entity, right? The S Corp itself is not going to pay income tax at the entity level. You're going to get a K-1 to report your respective share of income, deductions and credits on your individual return. Okay, so just like a C Corp, right, if you're an officer of the S Corp and you're providing services, you need to be compensated via a wage, pay yourself a reasonable salary. Similarly, if you observe corporate formalities, there is inherent limited liability. And then this is usually the best structure when somebody's deeply involved in the business. It's profitable, generally a simple structure, right? There's some planning aspects there between how much salary to pay, how much to pay, and net income, because as you see, the net income is not subject to self-employment tax, right? That's quite a savings there. So now we'll talk about limited liability companies, right? This is actually a state statute, right? So this is an entity formed under the state you're located in. If you have a multi-state operation, you should have legal counsel. If you do not, Perkins Coie will hook you up. So keep them in mind. That's absolutely imperative. There is an operating agreement required by law. So again, Perkins Coie if you don't have someone. And you can form it with one or more member. Typically speaking, if it's one member, it's generally considered a disregarded entity, and you'll file similarly to a sole proprietor, and that you'll file a Schedule C directly on your individual tax return. Usually, a multi-member LLC follows suit with a general partnership, right? You're gonna have income subject to SE tax. It's a pass-through entity that flows through to you as an individual partner, or member, I should say, of that LLC. Some CPAs advocate for an election of an LLC to an S Corp. I'm not gonna get into the nuances of why that's generally not best, but we typically do not recommend that per se. Okay, so another important thing to note, right? These are members, right? They're not partners, they're not shareholders, they are members, and what their interest represents is membership units. And there's, similarly to a C Corp, there's no restrictions on the type or number of members. And again, highlighting what I mentioned before, that the profit of a partnership goes on a Form 1065, where those K-1s are then generated for the individual members themselves. And you can have multiple units that offer flexibility within those units however you see fit. All right, so I highlighted some of the tax considerations as I went through, but I wanted to call some of them out for you here, namely that if there's a tax-friendly change to dividends, you know, fingers crossed if that happens, it could change desirability for some closely held companies. On the S Corp side, this is generally, right, the desired approach when you have profits above a reasonable salary level. And then an LLC, right, generally allows good flexibility when there's initial losses of an entity, and there's generally not as much administrative headache. All right, so we'll talk a little bit about legal considerations. Sole proprietors and general partnerships kind of fall under a similar boat, right? And then that if unlimited personal liability doesn't scare you, it should. If it doesn't, right, it's generally, right out the gate, it's the least administrative headache, and attorney bills are typically lower initially, right, until you get sued, right? So then it's kind of at your own risk, if you will, so stay tuned. And then C Corps, S Corps, and LLC have similar benefits in that they're formed with limited liability as long as the proper legal formalities are observed. So keep that in mind. And then you can prepare additional layers of protection if you want. You can have additional subsidiary LLCs. That doesn't necessarily make your tax reporting any more complex for you. Might be a little more legwork for your CPA, but nothing more generally outstanding. All right, so pop it out right in the middle here for you. C Corps, right? This is typically where angel investors will want to sit, venture and angel investors. That's because of the flexibility within the share classes. There's also potential for a tax-free transfer upon exit. And we'll talk about Section 1202 here in a little bit. But there's also, right, a board of directors which provides legal oversight. That's not a requirement in an LLC, and it's not necessarily available in other entity types. So an S Corp, right, other passive investors will generally not accept an S Corp because of the restriction of this common stock. There's not much flexibility there. So if one shareholder takes pro rata distributions, the other shareholder also has to take distributions representative of their ownership, right? So it's pretty strict from that standpoint. And then the LLC, right, is initially flexible when those initial losses are occurring. But keep in mind, some funds actually cannot invest in LLCs, namely ones that are tax-exempt entities. That's important to note. Yeah, and then one of the biggest administrative headaches, right, is waiting on K-1s if you're a S Corp or a partnership, right? You could have your whole tax return ready to go, and you're simply waiting on K-1s of some other entities. All right, so you've already set up, you've chosen an entity, and you're panicking right now. You're going, what did I do? You can change. It's okay, you can change, so keep that in mind. You can form an LLC at any time. You can incorporate through a tax-free transfer, right? Rules, facts, and circumstances come into play there a little bit, but it's possible to do. C Corps can elect S status at any time during formation or after. Just be aware, going from C to S, you know, after you've done it, there's a 5-year built-in gain period, right, that comes into play. So you can't flip-flop back and forth. Your type of entity, they have this 5-year holding period. If you sell appreciated property, right, you actually pay tax as if you were a C Corp, even if you're now an S Corp. So there's important planning considerations to keep in mind when you do switch. So everybody wants to get out and make big money. So there's some things to consider when you do that. Obviously, I talked about a little bit with the C Corps, right, is the issue of double taxation. This would occur, right, if you sold your assets for cash and you turn to your investors and pay them out as cash, right? Both would be taxed. So effectively, you're taxing the income twice. But in reality, most startups, when they exit, right, it's a stock sale. So it'd be no different than selling another held stock, right? Your basis less the sales price, and that's one simple tax for investors to report. And then the consideration with carryover losses at a C Corp that's beneficial against future profits, but you potentially have trapped losses when those entities are sold that are never released, and there's no benefit recognized when that occurs. A little bit about Section 1202. I know I talked about it earlier. Section 1202 is kind of exciting. It's essentially, if you qualify under these rules, you can exclude up to 10 million of a gain, okay? But I feel bad for the person, right? It's any stock acquired originally as a C Corp that's acquired after December 2010. So whoever acquired one on September 26th, 2010 is kind of out, you know? So unfortunately, you got to plan a little on those things. All right, so we're going to talk a little bit about initial accounting method selections, right? Seems kind of like a basic thing to pick. Am I accrual or am I cash? There's other methods to pick, but there actually could be kind of involved to switch from one to the other, so something to keep in mind. So cash basis, right? When you receive revenue, you recognize it. When you pay for an expense, you deduct it. It's the most simple form of accounting, right? That's probably the most basic, right? But it's not available to everybody, right? Namely, larger C Corps, those who have inventory that are material to the business, right, actually cannot be on cash basis. So it's a lot of planning aspects that come into play with cash basis. That's why it's not available to some larger entities. So it could be beneficial if you have high vendor receivable or high receivables, right? If you're not collecting right away, those aren't income until you actually get the money. And then on the flip side, right, if you receive cash from your customers, and you have high vendor payables, right, you're on the flip side where you're getting cash potentially before you're paying bills. On the contrast, right, is accrual basis, right? Accrual basis, you only recognize income when it's earned, and you only deduct expenses, right, when they are incurred, right? So this includes vendor payables and payroll taxes due. It eliminates a lot of these common year-end strategies we try to employ. And it's available generally to every business, right? And like I mentioned, it's required for larger businesses and businesses where inventory is significant to the business. If a business has to convert from accrual to cash, it can create a negative effect, actually recognizable income, but they allow you to spread that out over the course of 4 years. It's called a 481A adjustment, so it's not all bad, right? So next is a hybrid method of accounting. We're not going to get into that specifically. One example I threw out is the completed contract method for construction, for instance. We just don't have quite the time to get into that today, and probably not applicable to most of you here. You can convert from cash to accrual at any time, and actually the IRS prefers the accrual method. The opposite's not true, right? If you initially accepted accrual and you want to switch to cash, you have to specifically get approval from the IRS, which, as you can imagine, could be quite arduous. So yeah, consider this carefully, right? Because you have to select this when you first file your return, right? There's implications that kick back from that. All right, so you've got a business going, you're starting to get expenses, right? It seems pretty straightforward, but the IRS likes to have rules with everything, of course, and so we have 3 main categories that we break things up in, those being organizational costs, startup costs, and operating costs themselves. So organizational costs are amounts paid to create or organize a business. They include legal, required for organization, right, necessary accounting services, expenses of temporary directors and organizational meetings, and the fees paid to government entities as well. This does not include costs incurred to issue stock, which are non-deductible. And then contrasting that, we have startup expenses, right? So you're getting going, you're getting people on track. This is an example of fees paid to investigate the creation of a business and costs paid prior to the date the actual business begins. And when the business begins is not necessarily when you get your first dollar, right, that you frame on the wall. It's a little bit more of a fact-based concept than that, so keep that in mind. But this would include things like advertising, right, getting your brand out there, personal costs of training, travel, and related expenses there, and then professional expenses, right, that are not organizational in nature. And this does not include research or experimental or developmental costs, which are always deductible. So you've got these expenses, you've categorized them. How do we deduct them? Well, from each category, organizational and startup, you can deduct up to $5,000 from each category. Any amount over that amount, you amortize over the course of 15 years. And then we love phase-in, phase-outs, right, in tax law. So once you're over $50,000, it starts reducing the amount that's currently deductible until eventually you're amortizing the whole amount. Another thing that happens commonly, right, as a founder gets going on a business idea, before they form, they start paying for expenses and accumulating expenses. Those are valid expenses for the business. So the best way to do that is to either handle that with a founder loan or a capital contribution to get those on the books. All right, so not too different from startup expenses. Intellectual property, we have to break into various categories, and their deductibility depends on the various categories. The main being research costs of developing a patent or copyright, and then costs of acquiring a patent or copyright. So of course, always talk to your CPA before you tack this one. So research and developmental costs are generally all reasonable costs related to development or improvement of a product. So a product can be a pilot model, a process, a formula, invention, technique, could even be a patent, et cetera. And then research costs are deductible when paid or incurred, regardless of whether the business operations have begun. And this is a nice little tax court case that specifies, right, that these deductions aren't limited to a successful project or one that's success is probable, right? So you can have a failed venture, right, that still generates deductible expenses there. Okay, so when we look at patent costs, self-created patents specifically, right, these would be specific to legal and other administrative costs related to acquiring the patent. Added to these costs are any costs related to defending the patent, which can be a costly endeavor, as you can imagine. However, once there's been patent infringement and you have costs related to stopping the infringement, they're deductible in the current year. And these costs are not current year deductions, rather they're depreciated over the patent's useful life or the legal life, whichever is less. So contrasting that is patents that you go out and buy, right? So acquiring of a patent is not as generous as one that you create, namely that you have to amortize it over 15 years, regardless of the legal or useful life. And then if there's any unamortized portion of the patent or copyright, it can only be written off if the entire business that's acquired is written off as worthless. And so as you can imagine, a common situation, right, as a founder comes up with intellectual property, he then makes a company to make use of that property, licenses the property to the entity, and compensates himself for that, which is completely fine under that simple arrangement. But investors won't touch a company that do not own the intellectual property within the company, right, for obvious reasons. So it should generally be transferred as initial consideration. And then the investors will be concerned about how you intend to protect that property as well. And then this is my favorite one. I don't know why. It's just one of the simple ones, right? This is the R&D credit. You may have heard about the R&D credit. It's formerly the credit for increasing research activities. And it's previously not been a great option for startups that experience losses. Initially, it was only deductible against income. And now they have this credit that's deductible also against payroll taxes, right? So you could be a startup that has a tax loss and has employees, and you can still get a great benefit because you're offsetting your payroll taxes. So this specific credit is quite nuanced and challenging, so make sure you talk with your CPA and don't miss out on the opportunity from that standpoint. All right, anybody have questions?
You always do such a nice job of making this information, I think, very digestible for us. So I'm sure people have questions. I'm going to turn, yes, all the way in the back.
One correction, and then I have a question. Oregon doesn't require an operating agreement for LLC.
Oregon doesn't require an operating agreement for LLC.
My question is, why do you dissuade people from taking an S-corp election with an LLC?
Why do you dissuade people from taking an S-corp election?
Yeah, so I have office hours tomorrow. If you want to come by, we can talk a little bit more about the details, kind of the nuances there. I have several clients who are LLCs who are also S-corps, right? There's no problem in operating in that way, but there's some nuances. It's more legal based, but we can talk more about it if you want to come to the office hours. Yeah.
Nice pitch for office hours, Jordan. Really well done. Any other questions from the audience for Jordan? Now's your chance. Who comes up with all these rules? That's what I want to know.
I don't know, but it keeps me employed, so.
Yeah. Okay, last chance for question. Yes, sir.
If a company just has an exclusive license versus purchasing a piece of intellectual property, do they get the same benefit?
So if they have an exclusive license for purchasing a piece of property versus, tell me that again.
Exclusive license versus purchasing.
Versus purchasing, can they get the special credit?
Yeah.
Or are you talking about like the research credit or the acquiring a patent deductions, the amortization? Yeah, so it's amortizable over 15 years, right? So it's different. If you create it, you get to either take the amortization over the useful life or legal life. Sometimes it's shorter, so it's more advantageous. But if you purchase it, it's a 15-year amortization.
But exclusive license versus purchase.
Yeah, I'd have to look at the rules there specifically. I'm not sure off the top of my head on that one. Yeah.
Office hours tomorrow available to you. Anybody else? Yes. ERC
Yes.
tax credits for startup companies relevant to?
Yes.
Yes.
Yeah, so there's different rules between the 2020 credit of the ERTC and the 2021 credit. You're probably aware of that. Initially, right, if you're a business formed before, I think it's pre-2019, February something of 2019, you have to show a gross revenue decline of 50% or greater compared from 2020 to 2019 on a quarter-by-quarter basis. That or you're shut down partially or fully by a government mandate. The 2021 credit's more beneficial in that the reduction only needs to be 20%, right? So it's a lot more people qualified there. But yeah, there is a nuance that there are qualifications for startup businesses. We could look at your specific fact pattern to see what's going on there, but there is specific rules to startup businesses. There's dates when you had to be formed, pre and after, so just be aware of that. Yeah.
Gosh, do you guys remember 2019? Anyways, any other questions from anyone for Jordan? Okay. Yes, Aaron. Did Evan Dickens survive the second tax deadline? Excellent question.
His office door's been closed. I have no idea. I think he's still working, as far as I know. Returns got out. I don't know if he's still working or if he's sleeping at this point.
We need to check his hydration levels and take him some snacks. There's a whole bunch of tiny sandwiches over there where we could get started
I will get a
on.
plate full. Thank
Please
you.
do. Anybody else? Okay, thanks, Jordan. Thanks for coming back.